So November 2019. Ilikuwa question 4B. On est 4C, ama 3. So question 4C of November 2019. So November 2019. So question 4C is called Benita Contractors Limited. So we'll just read again to refresh, then we can take a look at the question. It says Benita Contractors Limited operates in the construction industry. On 1st of November, the company won a tender for the construction of 2 projects, a hospital project and office complex. Construction of the projects commenced in January. The following details relate to the 2 projects for the year ended. So opening balances for materials, accrued salaries and wages, plant, written down value, cost of work done, value of work certified to date, then transactions undertaken during the year, material delivered to site from store, from supplier, plant purchased at cost, subcontractors fees, consultancy fees, inspection fee, salaries and wages and office expenses, material transferred out. Then you have material sales, plant leasing charges, direct expenses, cash received from subcontractor, cumulative value of work certified, as of 31st December, value of work uncertified, then balance carried forward, material on site, accrued wages, additional information, consultancy fees for the hospital project includes 40,000 prepaid for year 2019, wear and tear allowances on plants were provided at the rate of 12.5%. Per annum, direct expenses accrued and not reflected above were as follows. As of January, as of December, required a schedule showing the taxable profit and tax payable, if any, by Benita Contractors Limited as of 1st December. So we had already started the fresh one. So we can put the figures we had already. So we are preparing a contract account. So this is hospital project. Then you have office complex. Itagani na sumbua sana. Are you okay? You can see. Ama mnaona kuna giza. Mnaona kuna giza. Na wenzetu kule online wanaona hiyo taa inawasumbua. Haya. Tulikuwa tumeweka kama materials na hii ilikuwa 66,000 na hii ilikuwa 7. Tulikuwa tumeweka materials. Then we had also put salaries and wages. So we had salaries and wages. Here hospital ikawa ngapi? 119. Huh? 119,500. Hii ikakuwa 180,800. This one was 180,800. That was salaries. Tukaleta investment allowance on plant. Hii ya kwanza itakuwa 19. 19 na ile ingine itakuwa 27. 27,000. Hiyo ni plant. Then cost of work done, you might not need that one immediately. Cost of work done, lakini tutatumia tu wakati wake inapofika. Value of work certified, hiyo tutatumia na cumulative year, ile at end of the year. It will give us income which we credit. So I need to put the credit side. Wacha tuweke the credit side. So value of work certified is the income, whatever the architect are certified, that's the payment they should expect to receive. So hiyo ndio inakuwa revenue. So office complex, like that. So we let up a value of work certified. So to get the value of work certified in the current period, you'll get value of work certified at the end of the year. It's given. Pale mwisho, just before balance carried down, cumulative value of work certified is 700,000. Then you deduct cumulative value of work certified in January. 700,000 minus 200,000 will give you 500,000. Then cumulative at the end of the year for office is 860. Then you subtract in January 160. Then that gives you 700. Do you need your income on expect? Like that, 700,000. Then you come to transactions during the year. So here materials tumemaliza. Materials delivered to site, we've done that. From store, from supplier, plant purchase to tumemaliza. Tuweka subcontractors fees. Subcontractors. Subcontractors fees need 18 for the office complex. Subcontractors fee nafikiri mahali pa light sasa tumepita. The subcontractors fees is 18,000. Then we come to consultancy. So consultancy fees, there is additional information you get in note 1. Consultancy fees for the hospital project include 40. It's just 14,000 of shillings prepaid for the following year. So utachukua 30,000 minus 40. You get 29,960. So 40, and then the other side is just 29. That is consultancy fees. Then you bring in inspection. And inspection fee is 10,000 and 5,000. That's inspection fee. Salaries and wages, we did that. Head office expenses, we cannot charge here directly because it's not a direct contract cost, but we'll see how to charge it. Material transferred out, we finished with that. Material sales, we also finished with that. So we only debit direct costs, direct contract costs. So we'll debit also plant leasing. So there is a plant which we are using. So plant leasing charges, and we have 400 and 500. That's plant leasing charges. Direct expenses, there's some adjustment. For example, for the hospital project, you take the 3,000, then you come to note 3. There's an opening balance, so to subtract you accrued brought forward in January. So minus 200 plus the 1,000 at the end of the year. So that should be 3,800. Financial adjustments. Then for office complex, direct expenses is up 2,000 plus accrual at the end of the year, 400. It's 2,400. Unit direct expenses. Cash received is not an expense. You for bank, right? For year-end transaction. Cumulative value of work certified to share to me. Value of work uncertified is closing stock. So not credit closing stock. It will be certified next period. Value of work uncertified. Unit closing stock. The accountant, only the architect will certify it next period. So what is remaining uncertified is closing stock of 30K here, 30,000 and 45,000 or 42. Value of work uncertified. Materials, accrued wages, consultancy, the rest we had already done. So out of this, you can be able to get contract profit or loss. Just from the direct contract itself, you can be able to get a contract profit or loss like that by balancing off this T account. This would be 5,000. This is 742. This is 530. This is 742. We get that. So that will bring down the contract profit. So below it, we can have the profit and loss account. Then you charge the head office expenses in the profit and loss account. Then we get a final profit or loss. So umepata hapa ni hospital ni kama ngapi? 311. Kweli? 311? Unapata 311 kweli? Wale wengine wanapata nini? Unataka confirmation. 281. So hii ni 281. 40. So hapa ni hii ndio 281, 340. Na ingine 423, 100. We bring them down now. 281, 240, 423, 100. Three 340. So hapa itabaki 421. 100. Ukitoa 2000, sio? Wale wengine wameconfirm hivyo 423, 100. Umeconfirm hivyo. Kwa nini watu wako silent? Ngojea confirmation. It's 422, 300. There's not 421. This one is 422. 300. This is 420. So that's not even taxable income. Now we use percentage of completion method to get taxable income. The taxable income, we will now apply the percentage of completion method. That's on a hospital project. And we're using the first formula, if you remember, for computing the percentage of completion. We said a cost to date certified, we divide by estimated total cost or estimated cost of completion. Then you multiply by the profit. You don't need to, it's confirmed is 422, 300. Thank you very much. So we use the first formula. The first formula said, get the cost to date certified. So I can get the cost to date certified, this cost, by simply taking this and subtracting the profit. For the hospital project, it will be 530,000 minus 281, 340. I'll get the debits. So the debits are going to be 248. 248,660. You divide by estimated total cost. Unaanza January. By January, you get balance brought down in January. Cost to date, the cost of work done is 200. Mpaka January ni 200. Then for this period is 248,660. Then kile kinabakia is what is uncertified, is 30,000. Then you use that to multiply the profit, 281,340. Try and work out that. That would be, okay, we didn't multiply by 100. It will be the same thing, getting the percentage first and then getting the percentage of profit with the same, come out to multiply that by profit to right away. So that will give you the amount they can recognize as profit based on work certified. This one will give you 146. 146, 153.855. Then you bring in the office complex. You do the same thing. Get the cost to date certified. So 742,000 less 422,300. So you get 319. 319,700. You divide by the cost of work done up to January is still 200. Cost of work done plus the cost this year of this period, 319,700, plus what is left to complete 42,000 times this profit down there, 420, 423. This one will give us 239, 220.064. And when you add these two, we get the total profit for the company. The examiner wanted the profit for beneath contractors. So total for total tax. Nasema? No, it's at the beginning of the question. Both have 200. Look at the beginning, balance in January. Cost of work done for hospital is 200,000. The office is also 200. So now we leave property developers there and we move to another topic we call tax investigation. So we'll be looking at three areas of investigation, starting with PE investigation, then VAT, and back duty investigation. So we'll be looking at three areas of investigation. So our next discussion is investigation. We're talking about tax investigation. Investigation. Yeah, about duty. Finally, love VAT. So we'll begin by looking at PE investigation. So what is PE investigation? So say this is an in-depth examination. The investigation, you say this is an in-depth examination. This is an in-depth examination of the books. This is an in-depth examination of the books and records. This is an in-depth examination of the books and records at the premises of the employer, at the premises of the employer, at the premises of the employer, at the premises of the employer. Then you say, usually pay audits are conducted. Usually pay audits are conducted. Usually pay audits are conducted by officers from the Revenue Authority. Usually pay audits are conducted by officers from the Revenue Authority. By officers from the Revenue Authority. So we say there can be a routine or ordinary audit. There can be a routine or ordinary audit. There can be a routine or ordinary audit. However, an audit can also be triggered. However, an audit can also be triggered. However, an audit can also be triggered by certain events. An audit can also be triggered by certain events. The events that may trigger a pay audit include the events that may trigger a pay audit include the events that may trigger a pay audit include A, non-remittance of the pay amounts. Non-remittance of the pay amounts deducted. Non-remittance of the pay amounts deducted by the employer. Non-remittance of the pay amounts deducted by the employer. B, fluctuating and late payment. Fluctuating and late payment. Fluctuating and late payment of the pay amounts deducted. Fluctuating and late payment of the pay amounts deducted. C, irregularities detected. Irregularities detected through the examination. Irregularities detected through the examination. Irregularities detected through the examination of pay end of year. Irregularities detected through the examination of pay end of year returns. Then D, employers whose final accounts submitted. Employers whose final accounts submitted to the Revenue Authority. Employers whose final accounts submitted to the Revenue Authority raise suspicion, e.g., where the salaries and other staff expenses, claimed in the accounts, are usually much higher, compared to the pay remittances, by the employer, E, information from third parties, about the employer, violating pay regulations, or rules. F, information from the taxpayers' recruitment. Information from the taxpayers' recruitment unit. Information from the taxpayers' recruitment unit of the Revenue Authority. Information from the taxpayers' recruitment unit of the Revenue Authority. The next one, G, random selection, random selection, random selection based on a risk criterion. Random selection based on a risk criterion. Random selection based on a risk criterion. Next subheading, the objectives. The objectives of a PE audit. 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 The first one is to sensitize the employers, to sensitize the employers on their obligation, to sensitize the employers on their obligation to operate, on their obligation to operate the pay system, to sensitize the employers on their obligation to operate the pay system. B, to educate employers, to educate employers having difficulties, to educate employers having difficulties in managing, the pay system, having difficulties in managing the pay system, having difficulties in managing the pay system. Next, to verify that pay is calculated correctly, to verify that pay is calculated correctly, to verify that pay is calculated correctly, that pay is calculated correctly, deducted and remitted, deducted and remitted to the revenue authority, deducted and remitted to the revenue authority. D, to detect schemes, designed by the employer. To detect schemes designed by the employer, to detect schemes designed by the employer for evading tax, to detect schemes designed by the employer for evading tax. Then E, taking corrective measures, to counteract any tax evasion. Taking corrective measures to counteract any tax evasion schemes, and improve on tax compliance, Then G, to collect additional revenue, by charging tax on salaries and allowances, to collect additional revenue by charging tax on salaries and allowances, to collect additional revenue by charging tax on salaries and allowances that were paid outside the payroll, And finally, H, to verify the correct transfer. Of pay details. To verify the correct transfer of pay details. from the payroll to the I-tax system. From the payroll to the I-tax system. So that is what we call the investigation. So to illustrate that, we look at May 2016. May 2016 must be question 2. May 2016 question 2 is called Worker Enterprises. May 2016 question 2 is called Worker Enterprises. May 2016 question 2 is called Worker Enterprises Limited. Not just Worker Enterprises. So this is May 2016. A is called Worker Enterprises. Question is Worker Enterprises. Kalamu faint again. We'll read through the question. Worker Enterprises. The question reads, Worker Enterprises is a small retail business dealing in fast-moving consumer products. Now, the Revenue Authority suspects that the business has been filing fraudulent returns and has requested for financial statements from the business. The business provided the following details for the years ended 31st December 2015 and 2015. So we have an income statement. So we have turnover, less cost of goods sold, gross profit, proceeds from sale of furniture, capital gain on sale of plot, giving you total income, less expenses, purchase of furniture, general expenses, rent and rates, depreciation on motor vehicle, custom duty, hire purchase cost, salaries and wages and net profit, statement of financial position as at 31st December, non-current assets, furniture costs, motor vehicle at costs, current assets, inventories, accounts receivable, prepaid general expenses, prepaid rent and rates, cash and cash equivalents, total assets, financed by capital at net profits, less drawings, current liabilities, you have accounts payable, accrued rent and rates, interest due on hire purchase, total capital and liabilities. Then we have additional information, turnover and purchases were inclusive of VAT Act at the rate of 16%. The turnover excludes cash sales. During the year ended 31st December, the business paid the following expenses out of cash sales: telephone and postage, school fees, repairs and maintenance, insurance. The bank balance is included in the cash and cash equivalents. The following details were included in the bank statement: personal expenses, general expenses, rent and rates, hire purchase interest, payments to creditors, receipts from debtors. The following assets, I think, were purchased by the business, were not included in the assets register. So we have computers, fax machine, saloon car delivery van, computer software. The Revenue Authority has established that the statement of financial position forms a good basis for computing the taxable profit. So what the examiner is telling you already is he wants you to recompute the profit, but you use the statement of financial position because it forms a good basis for computing the taxable profit. All expenses are to be adjusted on the basis of the statement of financial position, which has been provided. Required A, using suitable computations, confirm the accuracy or otherwise of the taxable profit of work enterprises for the year ended. B, summarize 5 types of preliminary information that you might require from the business in order to further ascertain the accuracy of the taxable profit. So we are preparing, or rather computing, to prepare a statement for taxable profit. Yeah. So remember, you are computing. So I want you to open your working notes and recompute what we need for the trading account. So you'll compute the first, look for credit sales. So for credit sales, you prepare, I think it's accounts receivable. You prepare that. Accounts receivable account. That should give you the credit sales. Then you also prepare, you look for credit purchases. Using the statements of financial position, you can do that and get accounts payable, which will help you to determine the credit purchases. Then using those, at least you'll be able to start off your trading account. You can be able to start off your trading account after that is done. So you can do that. In the meantime, you can also take a break, but you can try and get credit sales and credit purchases. Then that will be very useful to us in trying to prepare the trading account. Tumepata credit sales ngapi? Ndugu zetu wa online, credit sales tumepata ni ngapi? Najua hatuwezi anza trading account kabla hizi vitu viwili. Hizo workings mbili. Unapata credit sales. Sema piga yoyote tu nipata. Huenda ikawa yako ni correct. Unajua unaweza kataa and you've done the correct thing. Kuna mtu hapa very bold anatuambia and it's correct actually. Anasema ni 4990.4 credit sales. Umepata hivyo? 4990. Hapa physical hakuna mtu anapata answer kama hiyo. Kwani nyinyi mmebalance hiyo account namna gani? Ladha anasema ni 4990.4 which is correct. Na credit purchases umepata ngapi? Mmesahau double entry. Najua mimi hapa sifundishi double entry. Sijui mnajua. Si tayari mnajua double entry. Nilisoma kwa masomo mengine. Sio hapa. So I will not pretend that I've taught you any double entry. Hapa tunaitumia tu kama tool. Ladha tena anatuambia credit purchases ni 1911.2. Is that what you are getting? Unapata hiyo 1911.2. That's what you got. Sales. Nini hujapata? Purchases. Sasa tutaenda kwa statement of financial positions. Ndio tulipewa kwamba hapo ndio kuna information. Wanasema statement of financial position forms a good basis for recomputing. Tutaka recompute, unaenda kwa statement of financial position. So under current assets, kuna kitu inaitwa accounts receivable. What is the opening balance? The balance ya 2014 ni 1640. Unakuja kwa accounts receivable, si ni asset account. Unasema balance brought down. Now balance brought down tumesema ni 1640. I'll also put opening balance for current liabilities. Accounts payable, opening balance ni 1528. Na hii ni liability account. So unasema balance brought down to 1528. Then kuna bank statement. Kuna bank statement pale note number 3. Ukiangalia kwa bank statement wanakuambia kuna payments to creditors. Payments to creditors ni 2460. So you credit bank, you debit bank. So this is payments to creditors in 2460. Then kuna receipts from debtors. So receipts from debtors uta debit bank. Na una credit accounts receivable bank. Receipts from debtors wanasema ni 5890. 5890. So ukimalizana na bank statement hakuna entry nyingine. So tutarudi kwa statement of financial position and you put the closing balances. Closing balance ya accounts receivable ni 4389.6 closing balance. So remember balance carry down 4389.6. As hiyo ni inventory ni 740.4. That was the inventory. Hii ni 740.4. Then you close that. Hapa hakuna entry nyingine. You call it in accounting balance off. Ukiclose hiyo, the balancing figure hapa itakuwa credit sales. That is simply the difference in the account. You enter the balancing figure. You take a credit sales. Unachukua 5890 na add 740.4 and the total is 6630.4 So 66, 30.4. We subtract 1640. And the balance there is 49, 90.4. That's the amount we will use as credit sales in there or as turnover in the trading account. Then for accounts payable, we can also get the closing balance and the current liabilities, and the closing balance is 970, not 9. Accounts payable, yeah, 979.2. So we come here and put the balance cut down. 979.2. Then you close off that. You get credit, purchases, as the balancing figure. It's simply the difference in the account. So 2460, you add 979.2, you get 34, 39.2. You take to this side, 34, 39.2. So you subtract 15, 28, and the difference is 19.2. So that's enough to at least start the trading account. But before you start the trading account, you need to read additional information. So you keep that in mind there. Note 1 inasema turnover and purchases were inclusive of VAT. So we're supposed to adjust for VAT. And note 2, turnover excludes cash sales. So what the examiner means by turnover is only credit sales. It does not include cash sales. Now with that in mind, we can start preparing this statement here. With that in mind, we prepare this statement. So we start with turnover. So the meaning of turnover here is credit sales. So turnover is 1. And that's 4990.4, but we multiply by 100 over 116, so that you only have the cost without VAT. That's 4990.4. This is 43.069. Then we bring in cash sales. And cash sales, you're going to get by adding the items in note 2. Because note 2 anakwambia the turnover excludes cash sales during the year. The business paid the following expenses out of cash sales. So we'll add telephone and postage plus food fees plus repairs and maintenance plus insurance because they were paid out of cash sales. So that should give you something like 322. Then you add this, you get 4624.069. Then you say less cost of goods sold or just cost of sales. So opening stock you can get from the statement of financial position. Under current assets, opening inventory is 2881. 2881. Then you add purchases. Now purchases, according to note 1, was inclusive of VAT. So 1911.2, again multiplied by 100 over 116. So that we get purchases without VAT. And this gives us 1647. 586. Then you lessen the closing inventory. So the closing inventory again from the statement of financial position is 4389.6. So 4389.6 is closing inventory. So that should give us the cost of goods sold. This gives us 138.986. That should give us gross profit. This is 4485.083. Then now you'll be comparing with their statement, not for anything, but just to get the expenses they are charging the income statement. For example, after gross profit, you can look for trading incomes. What did they add to gross profit? Proceeds from sale of furniture. We cannot add proceeds from sale of furniture because it's a capital item. So that's what worker enterprises have added to gross profit. They had also added capital gain on sale of a plot, which we can also not include. So there is no additional trading incomes. So we just say there's allowable expenses. And we'll be using theirs to compare. So in their statement, the first allowable expenses they are charged is called purchase of furniture. We cannot charge purchase of furniture, but then they have general expenses, which we need to rework. So general expenses. We'll rework it by first picking the expense that have been credited in the bank statement, note 3. General expenses is 792.8 from the bank. 792.8. Then we look at the statement of financial position. Under current assets, you're going to see, is it current assets? Should be current assets. This prepaid general expenses. So we have prepaid general expenses under current assets. Prepaid from last year was 98. So here last year prepaid in our 98. Then prepaid by the end of this year, we subtract prepaid by the end of this year is 178.2. That should give us the general expenses cost. $792.8 add prepaid of last year minus prepaid of this year. The result is 712.6. That is general expenses. Then rent and rates. Again, you go to the bank statement to get the rent and rates that was paid. So rent and rates that was paid is 68.4. That is what was paid. 68.4 was paid. Then you go to the statement of financial position for adjustment. There is prepaid rent and rates, and our current assets. Prepaid brought forward is 24.6. So 24.6 prepaid rent. Then prepayment at the end of the year is 72.8. That's prepaid at the end of the year. Then again, under current liabilities, accrual. Accrued rent and rates. Accrued from last year is 36. You subtract that in there last year. Then you add accrued by the end of this year is accrued by the end of this year tumesema ni ngapi? 24, sio? 24 hiyo na so that should give us the rent and rates expense. So 68.4 add 24.6 minus 72.8 minus 36 plus 24, you have 8.2. That's rent and rates. Their next expense is depreciation, and depreciation expense is not allowable. So we ignore depreciation. Huyu anaitwaje? Silpa, yeah? Hiyo yenyu ndio iko na typing error. I have the original question. So the question we are looking at was typed. So probably walitype error. Ananiambia 117.4. It's 117.2, not 0.4. The papers you're looking at were typed. But me, I have the original. I'm using the original. So that's rent and rates. Depreciation, we said you leave out. Customs duties are tax, you leave out. Then kuna HP interest. HP interest, as usual, we start from the bank account. Bank account, HP interest is 29.6. 9.6 bank account. Then under current liabilities, kuna interest due on our purchase. Yeah, last year 28, we subtract. Yeah, this year accrued interest is 16, we add. So 29.6 minus 28 plus 16, 17.6. So that's HP interest. Salaries and wages, you will not get any information, even in the statement of financial position. So just take their figure. The it is, it cannot be adjusted. We don't have information. Salaries and wages, we'll just use 16. We don't have information in the statement of financial position to verify that. Then there are still more expenses we need to charge. So those expenses can be found in note 2. Like telephone and postage. Telephone and postage is 48. School fees is not allowable. Repairs and maintenance. Repairs and maintenance is 94.6. Then we have insurance. We're only picking a lot of expenses. Insurance is 36.6. Then you look for investment allowances. Investment allowances, we start with furniture. So furniture, you go to statement of financial position. So statement of financial position will give us the opening balance of furniture at the beginning of the year. Unasema furniture was 460 at the beginning of the year. Then you go to the income statement and the expenses, this purchase of furniture of 360. So you add 360 was additional furniture purchased. Then you go to the income side, there's proceeds on sale of furniture, 240. So there's a disposal. You subtract 240. That should give you the balance of furniture. Then the rate for furniture is 10%. So 460 is opening balance at the beginning of the year. 360 is what was purchased, minus 240 what was sold. The difference is 580. 10% is 58. Then you can bring in motor vehicles. Vehicles at cost. Opening balance for motor vehicles from statement of financial position is 1565. 1565.4. Then you go to note number. They bought a saloon car, so I add here was 2.8 for still motor vehicles. They bought a delivery van, so I add another 720. All this you can take 25%. That will be 1565.4 plus 2,800 plus 720. We multiply by 25%. And we get 1271. And 35. That's motor vehicles. The other assets there that have not been captured, like computers. The cost of computers is 368. Then you get 25% of 368. It's 92. Then you have fax machine. Fax machine, the cost of acquisition is 120. You get 10%. Then you have computer software. Computer software is 150. That's 27.5. So that should give us the allowed expenses. This is 40, 68, Which one? 0.45. The profit is 416.63. So we are supposed to comment on B, summarize 5 types of preliminary information that you might require from the business in order to ascertain the accuracy of the computation. Just say further information required. Further information required. Further information required. To further ascertain, so the further information required to ascertain the accuracy of the taxable profit. Further information required to ascertain the accuracy of the taxable profit. The first information, details. Details of sales and purchases. Details of sales and purchases. Details of purchase, sales and purchases. E.g., details of sales and purchases, e.g., ledger accounts, journal accounts. E.g., sales ledger and purchase ledger. Sales ledger and purchase ledger. Sales ledger and purchase ledger. Another information required, the cost of goods sold, the cost of goods sold, the cost of goods sold, since the figure, the cost of goods sold, since the figure is much higher, since the figure is much higher, since the figure is much higher in their records than the amount computed, hence vouchers, expense vouchers are required, hence expense vouchers are required. The other item is general expenses. General expenses. Determine personal and business 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 expenses. Next information, the usage of assets. The usage of assets for both personal and business. The usage of assets for both personal and business. The usage of assets for both personal and business to determine the investment allowances claimable. Determine the investment allowances claimable. Determine the investment allowances claimable. I think that's it. So that was pay investigation. So then, if there's any question you can ask, otherwise I introduced back duty, we will not finish definitely, but at least we can begin. So next type of investigation, we call it back duty investigation. Back duty investigation. Back duty investigation. Back duty investigation. Back duty investigation, please write. To say back duty is a general term. Back duty is a general term. Back duty is a general term used to refer to the assessment. Back duty is a general term used to refer to the assessment. Back duty is a general term used to refer to the assessment of tax in arrears. Used to refer to the assessment of tax in arrears. Then you see tax arrears may be as a result of tax arrears or tax in arrears may be as a result of A. Tax in arrears may be as a result of A, under declaration of income, under declaration of income over a period of time, under declaration of income over a period of time, under declaration of income over a period of time. B, non-declaration of income, non-declaration of income, non-declaration of income. And C, a taxpayer may have claimed. A taxpayer may have claimed. A taxpayer may have claimed fraudulent expenses. A taxpayer may have claimed fraudulent expenses. Next, abetting, the sources of information. The sources of information. The source of information for a back duty case. The sources of information for a back duty case. The sources of information for a back duty case. The first source A, self-disclosure. Self-disclosure during voluntary disclosure program, VDP, self-disclosure during voluntary disclosure program. Or B, the former employees and business rivals. The former employees and business rivals. C, information from the tax investigation branch. Information from the tax investigation branch. Information from the tax investigation branch of the Revenue Authority. Information from the tax investigation branch of the Revenue Authority. B, public media, including social media, public media, including social media channels, public media, including social media channels. E, the exchange of information, the exchange of information between county offices, exchange of information between county offices of the Revenue Authority. F, government departments, state corporations, and county governments for tenders awarded for supply of goods, services or works, for tenders awarded for supply of goods, services or works. H, personal identification number, or in brackets PIN. Personal identification number, or in brackets PIN, that is normally required for various transactions. So we can stop there for today, so that you can put this heading for the next class. Yes, the methods for calculating the understated. Methods of calculating the understated income. So we begin from there. Methods for calculating the understated income. So let's start from there. What was 0.6? The one before the last one. Government departments, state corporations, and county governments for awarding of tenders for supply of goods, services, or works. Works need projects, the construction.